There are two major things that should be percolating in investors' minds as we close out the year. It's one, are you maximizing 2025's depreciation schedule? Because remember, the big beautiful bill has reinstated 100% bonus depreciation. This is your last chance to get in and soak up that depreciation. LeavenWealth has provided a couple different exciting opportunities by which that can happen. We're gonna have our investment fund, which we're diversifying, and this is the second point. They kind of bleed together. That second point is we're diversifying into some glamping, RV campground style commercial properties. And what that means is you're still gonna be able to maximize 100% of that bonus depreciation because it applies just as much there as it does with multifamily. We're diversifying our return because we understand and we've heard the investors call that markets are cycling in different ways. We wanna make sure that we're anchoring that cash on cash value for our investors at this time.
Some of the more exciting things are the new bill for tax write-off purposes. You know, we were getting less and less in write-offs every single year over the last 3 years as it was dwindling down from 2017-18 tax bill. And we've seen a huge uptick from our investors. They're very excited about the write-offs. The first deal in our investment fund is projected to receive about 100% returns. And what that means is a $100,000 investor will get $100,000 in write-offs from that property. So whereas it would have been closer to $30,000 to $40,000 before the bill. I think our investors can get really excited about all those write-offs that are gonna come.
The most exciting thing for our investors through investment is they're able to see different deal cycles at different times. And what that means for our investors is they're able to diversify their cash flow, and those value adds are happening at different times. So they're impacting that cash flow at different rates, where one is gonna be a bigger jump, but a longer term play. The other one is going to increase cash flow quicker on the front end. That's the beautiful thing about diversifying through a fund structure, is you're able to receive that cash flow at the same time that you're able to see those equity increases on the back end. It's incumbent on us to continue to fund smart deals as we move into 2026, and that's exactly what we're doing as we move in and evaluate different markets. We're really excited to celebrate some big wins with 2025. The two that come to mind are Brent Village, and that's where we're seeing a lot of the deal flow that we've seen through the relationships that we've built. It was an off-market deal where we were able to acquire that property for about 20% below what it's actually worth. So that means investors, day one when they invest, they're building 20% equity and they're seeing that grow immediately. So not only is there equity growth, they're experiencing that cash flow and they're getting that 100% bonus depreciation this year. And then there's the traditional value add with Midwest Portfolio 8, where we're seeing that new construction take place very, very quickly. The thing that was daunting about COVID was with new construction and unit turns, subcontractors were tough to find. We were seeing a bottleneck there. That bottleneck has opened up, and so has the bottleneck on deal flow. So as we go into 2026, the one thing that we're really excited about is how these last two deals have shaped up for us, mean increased deal flow, increased cash value, increased cash on cash returns, and better depreciation. One of the big questions that's on a lot of investors' minds right now, as we see some limiting of the cash flow in a couple of our deals, namely some of the Midwest portfolios, all of that is not of concern, and here's why. These winter months are typically much more difficult for maintenance, just with wear and tear on different systems, whether it's the heating system, the boiler system. There's a couple different things that we have to make sure that we have enough CapEx in the account to make sure we're servicing those things appropriately. There's not reason to worry as we see some of those market trends change. So too is an ebb and flow. This is real estate. It's not the traditional stocks where you can anticipate, the 7% annual returns that you see from your financial advisor. There's also not that crazy upswing potential in multiplying your equity and the diversification through those 4 different ways that you're making cash flow. So I want to remind you guys that you're making cash flow through depreciation, through the actual cash on cash, through the equity growth, and also with tenants being able to pay down the debt. So all of those are means and mechanisms by which your money is growing, despite us holding back some of that for CapEx.
I think 2026 will be extremely beneficial for everybody in the fund because of a couple reasons. One, obviously interest rates are starting to decrease, which is going to help all of us. But also we've expanded our investment fund to also include hospitality. But one of the benefits is that our investment fund consists of multifamily, ground up construction, single family, industrial, storage, as well as hospitality now. And so even though it's all real estate, it is well diversified. We will benefit from that diversification. I think also our investors can get excited that our deal flow in the last 6 months has been higher than it's been in 4 or 5 years. And that's because of the nature of the market. A lot of people having to offload their assets when they didn't plan to. And so we are going to see a reduction in those values where we can buy them right away, and then they'll increase in value through our value add approach. So I think 2026 is really geared up to be one of our better years.